You probably use a bank every single week. Your paycheck goes into one, you tap your card, you send transfers, maybe you have a mortgage. But if I asked you one simple question, what does a bank actually do with your money? Most people have no idea. And that's a problem, because if you want to understand how the economy works, how money is created, why crises happen, and why interest rates matter, you have to understand banking.
So, in the next 7 minutes,
We're breaking down the entire banking system. No jargon, no MBA required, just how it actually works. Let's start simple. Why do banks even exist? Banks weren't created to be marble buildings with logos. They started with a basic problem. People had valuable stuff and needed a safe place to store it. Hundreds of years ago, that stuff was gold and silver. Walking around with a bag of gold coins? Bad idea. So people deposited their gold with goldsmiths or early bankers, and in return, they got a receipt. That receipt said, this person owns this much gold. Eventually, something interesting happened. People stopped trading gold and started trading the receipts instead, because the receipts were easier. That's the birth of paper money. But here's where banking gets powerful. Bankers realized something. Most people never came back for their gold at the same time. So instead of letting it sit there, they started lending some of it out and charging interest. That's the core of modern banking. What banks actually do today. Strip away the complexity, and a bank does three main things: takes deposits, makes loans, earns the difference. You deposit $1,000. The bank pays you maybe 1% interest. Then it lends that same money to someone buying a car at 6% interest. That 5% difference, that's the bank's profit after expenses and risk. Banks are middlemen. They connect people who have money but aren't using it with people who need money to do something productive: buy a house, start a business, expand a factory. Without banks, money would just sit idle, and idle money doesn't grow economies. The part most people don't understand. Now, here's where things get interesting. When you deposit money at a bank, they do not keep all of it in a vault, not even close. Banks operate under something called fractional reserve banking, which means they only keep a fraction of deposits in reserve and lend out the rest. Let's walk through it. You deposit $10,000. The bank might keep $1,000 in reserves. It lends out $9,000. That borrower spends the $9,000. Whoever receives it deposits it in their bank. That bank keeps 10% and lends out the rest again. This process repeats. Your original $10,000 can support far more than $10,000 in total economic activity. This is how banks expand the money supply. And yes, in a very real way, banks create money, not by printing it, but by issuing loans. Because when a bank approves a loan, it doesn't hand over someone else's physical cash. It simply creates a deposit in the borrower's account. New money enters the system. That's modern banking. Why this isn't chaos? At this point, you might be thinking, wait, so banks just create money out of thin air? Not exactly. There are limits. First, profitability. If borrowers don't repay loans, banks lose money. Too many bad loans equals bankruptcy. Second, capital requirements. Banks are required to hold a certain amount of their own capital relative to their loans. This acts as a shock absorber. Third, regulation and oversight. And that brings us to the most powerful bank of all, the central bank. Above normal banks sits the central bank. In the US, that's the Federal Reserve. Think of it as the bank for banks. Its main jobs: keep inflation stable, keep employment stable, prevent the system from collapsing. One of its biggest tools, interest rates. When the central bank lowers rates, borrowing becomes cheaper. Banks lend more, the economy speeds up. When it raises rates, borrowing becomes expensive, lending slows, the economy cools. It's like a thermostat. Too hot, raise rates. Too cold, lower them. But it's a balancing act. Too much lending can inflate bubbles. Too little lending can trigger recession. How banks fail. Now, let's talk about when this system breaks. There are two classic ways banks collapse. One, bank runs. Remember, banks don't hold all deposits in cash. So if everyone panics and demands their money at the same time, the bank runs out, even if it was technically healthy. This happened during the Great Depression. It's why today many countries insure deposits. In the US, for example, deposits are insured up to a certain limit. That insurance prevents panic, because panic is what kills banks. 2. Bad loans. Banks want profit. Profit comes from lending. But if they get reckless and issue too many risky loans, eventually borrowers default. This is what happened in 2008. Banks issued massive amounts of risky mortgages. When homeowners couldn't repay, the system cracked. Because banks are deeply interconnected, they lend to each other. They rely on each other. So when one falls, others can fall with it. That's how financial crises spread. Why banks are so important. Here's the big picture. Without banks, most people couldn't buy homes, businesses couldn't expand, infrastructure wouldn't get built, innovation would slow dramatically. Banks take used money and redirect it into productive use. That process fuels growth. Yes, the system has flaws. Yes, banks can be greedy. Yes, regulation is necessary. But the core function, it's essential. Modern civilization runs on credit, and credit runs through banks. The entire system in one simple idea. Banking is about one thing, turning savings into growth. It connects savers with borrowers at massive scale. It expands the money supply through lending. It's stabilized by central banks. And it's constantly walking a tightrope between growth and risk. Once you understand that, headlines about interest rates make sense. Financial crises make sense. Even inflation starts to make more sense, because banking sits at the center of it all. That's banking, fully explained. Is there more complexity? Of course, entire careers are built on this. But now you understand the core engine behind the global financial system. And once you see it, you can't unsee it.